What we're going to be going over here is the rate of return on common stock equity by trading on equity. Now, what we mean by this trading on equity, that's where you're using borrowed money to obtain a higher rate of return here on the company's equity. And we go to our accounting equation here. We have our assets equal our liabilities plus our shareholders' equity. Well, our liabilities, that represents our debt here. Shareholders' equity, we're just going to represent it as common stock here. So it's a matter of how we finance these assets to generate income for the company here. And by using our proper debt financing here as a liability, we can improve the stockholders' equity here, their equity here. We're looking at it in terms of common stock, and we're going to look at it based on a rate of return here in our common stock. So for example here, we're just going to have these basic financials here. We're going to have some operating income, then we have a bond interest expense here, $130,000, and then total income here is $405,000, and then we're going to subtract out some income taxes here, and we come up with our net income here at $225,000. Now this is where our trading on equity comes into play here. So we're going to have our bonds payable, $1,500,000, and that represents our debt here, and then our common stock plus our retained earnings, that's our equity. So we have common stock $875,000, retained earnings here $575,000. So if we do a comparison here, our bonds payable here of $1.5 million compares with the equity here. We have the same amount here as debt with equity. Our equity is just $1,450,000 if you do your arithmetic, but nonetheless they're comparable here, so equal amounts here. So what we're going to do here through this trading on equity here, this is where a corporation can improve its return on its common stock equity through the prudent use of debt financing, and that's called trading on equity here. And that's where you're using this borrowed money here, and we're just looking at it in terms of bonds. You could also have preferred stock here, but we're just going to use it in terms of bonds here. And that's where you're going to attempt to obtain a higher rate on the money used here. So what we're going to be looking at here is our common stock equity. We want to have that greater than the cost of borrowing money here on these bonds. So let's just go to our general equation here, and we'll look at the first case here where we have a rate of return here on our common stock equity. So our general equation here is our net income over our common stock equity. And then when you're dealing with preferred stock, in the numerator you'd have to subtract out your preferred stock dividend, and in the denominator here you'd have to reduce your common stock equity by the preferred stock par. But in this case we're not using preferred stock in our example. We're just using the bond debt as our debt here. Okay, so if we plug our numbers in here, our rate of return here on common stock equity, our net income, we had $225,000 for the year here, and our common stock equity, well, it's this here. You get $875,000 in your common stock plus $575,000 here in your retained earnings. Add those together, you're going to come up with $1,450,000 here. So that would be our common stock equity here. Divide that into the net income for the year here, $225,000. You're going to come up with the rate of return on common stock equity at 15.52%. Now we have to look at our long-term debt percent, what we're paying on our long-term debt. So let's look at that here. We have the rate of interest paid on the bond debt. That's what we're going to be really doing our comparison here. So our interest expense, that's $130,000 for the year, and then our long-term debt here would be the bonds payable, $1,500,000. So divide that out, our rate of interest paid here is 8.67%. So this is the key here. When you're talking about this trading on equity, you're comparing your long-term debt here. In this case it's 8.67%. You have to compare it to the rate of return here on your common stock equity. It's 15.52%. So just through the comparison you can see they're trading on equity successfully here, because their long-term debt here of 8.67% here is approximately half of what the rate of return on the common stock equity here is at 15.52%. So it looks like a good trade here. Investing in the debt here, using this debt to increase the equity here, or the common stock equity in the company. So let's just go down and look at what we're doing here as far as our definition here. So Corporation A is trading on equity at a gain here, because they have the rate of return on their common stock equity here is greater than the cost of the debt here. So in this case, the money obtained from the bondholders earns enough to pay the interest. We paid the interest here, and it leaves a profit for the common stock shareholders here. Now, this is the case here where you gain. We were successful here because our rate of our interest paid here of 8.67% was less than what we gained here in our common stock equity. So if we've gone back to our accounting equation here, our assets, we invested in our assets here by either investing in debt here and plus the common stock equity or the shareholders equity of the company here, common stock equity here, and you see here the debt that was only costing us 8.67% here, and our rate of return on our common stock equity by financing those assets through debt here, we increased our we had a greater rate here of return on our common stock equity. So that's the case here where we had this gain here. Now, the other case would be here if the shareholders lose here if the cost of financing is higher than the rate of equity. So let's just go to our example. Say, for example, our rate of return here on equity was only, say, 10%, or let's say 8% or something like that here, and our debt financing here, our long-term debt here for our bonds was 15% or something. Because that wouldn't be using debt very successfully here, because you wouldn't be generating a greater rate of return on common stock equity. It would be less than the cost of your debt. So that's just then, by definition here, what they call here trading here on equity. When you trade on equity here, you want your common stock, your rate of return on your common stock equity here to be greater than the cost of the rate that you're paying here on interest for your long-term debt. Okay, so that takes care of our definition here, and you just understand here with the debt financing here what you have to determine what that's costing you, and then you have to determine what your rate of return on common stock equity. Compare them, see how you're doing here. You need your common stock equity, and you'd probably want it to be substantially higher than your debt costs. And if that's the case, then you're trading on equity successfully by taking on this debt here to finance your assets or to generate income for your company to increase the stockholders' equity here in the company.